What if the very instincts that helped your ancestors survive are now the exact forces destroying your financial future? This is the foundation of Stoic investing, a revolutionary approach that transforms how you think about money and markets. You wake up, check your portfolio. The market dropped overnight. Again. Your carefully planned investments suddenly look like reckless gambles. This cycle of fear and reactivity is exactly what Stoic investing was designed to break. Your rational mind tells you to stay calm, but something deeper, something primal, screams at you to do something. Anything. This ancient wiring in your brain once kept humans alive but now keeps them broke. Welcome to Stoic investing, where your greatest enemy isn't market volatility, economic uncertainty, or even bad luck. Your greatest enemy is the voice in your head. If you're ready to discover how ancient philosophy can revolutionize your wealth management strategy and transform you from reactive victim to disciplined investor, hit that subscribe button. This journey will challenge everything you think you know about money, markets, and yourself. The financial markets don't care about your feelings. They never have. Quick pause. Are you someone who checks their portfolio multiple times per day? If so, you're about to learn why that habit is costing you money. They're not designed to comfort you, validate your intelligence, or reward your good intentions. They're a reflection of collective human psychology, millions of minds all fighting the same internal battles you face every time you look at your portfolio. But here's what most investors never realize. The market isn't unpredictable because of external forces. It's unpredictable because human beings are predictably irrational. Watch yourself for just one day. Notice how your pulse quickens when you see red numbers. Be honest, do you feel that anxiety spike just thinking about market losses? That's your brain treating investment decisions like survival decisions. Feel how your breathing changes when CNBC mentions a potential recession. Observe the subtle shift in your posture when someone mentions cryptocurrency, meme coins, or the next sure thing. Your body is responding to financial information the same way it would respond to a predator stalking you in the wild. This is behavioral finance in action. Your brain, shaped by millions of years of evolution, treats investment losses like physical threats to your survival. The same neural pathways that once helped you escape danger now trigger panic selling at market bottoms and euphoric buying at market tops. Stay with me through this entire journey, because by the end, you'll understand exactly how to harness Stoic philosophy to build unshakable mental resilience in any market condition. Investment biases aren't just academic concepts. They're the invisible puppet strings controlling your financial decisions. Overconfidence bias makes you believe you can time the market better than professionals who've spent decades studying every chart pattern and economic indicator. Confirmation bias has you seeking out news that supports positions you've already taken, while ignoring evidence that might save you from disaster. The anchoring effect chains you to the price you first paid for a stock, making it nearly impossible to sell at a loss even when every rational indicator screams that you should. Loss aversion, that psychological quirk where losing money feels twice as painful as gaining the same amount feels good, turns you into a nervous wreck who celebrates small wins and agonizes over minor setbacks. But perhaps the most dangerous bias of all is the illusion of control. You believe that by staying glued to market news, checking your portfolio multiple times per day, and constantly adjusting your positions, you're actively managing risk. The truth? You're manufacturing anxiety. These aren't personal failings. They're human features. Every investor faces them. The difference between those who build lasting wealth and those who remain forever trapped in cycles of hope and despair comes down to one thing: self-awareness. Marcus Aurelius, writing in his personal journal nearly 2,000 years ago, captured this perfectly. You have power over your mind, not outside events. Realize this, and you will find strength. He wasn't writing about investments, but he might as well have been. The external world, markets rising and falling, economies expanding and contracting, companies succeeding and failing, lies beyond your control. Your response to these events? That's entirely within your power. Consider the broader implications. When millions of individual investors all succumb to the same behavioral biases simultaneously, their collective irrationality creates the very volatility they fear. Market bubbles form when overconfidence and herd mentality convince everyone that prices can only go up. Market crashes happen when fear spreads like a contagion, causing rational people to make irrational decisions based on what everyone else appears to be doing. The economy itself suffers when people make financial decisions based on emotion rather than logic. Resources get misallocated. Capital flows to the wrong places at the wrong times. Innovation gets starved while speculation gets fed. Individual psychological blindness creates collective economic instability. This is the paradox of modern investing. The tools that make wealth building possible, global markets, instant information, infinite investment options, also amplify every cognitive weakness humans possess. The more choices you have, the more opportunities you create for bias to derail your judgment. The faster information travels, the quicker fear and greed can spread through your decision-making process. But what if there was a different way? What if instead of fighting your psychology, you learn to work with it? What if the path to financial freedom wasn't about predicting market movements or finding the perfect investment strategy, but about mastering the one variable you actually control, your own mind? The Stoic investor doesn't ignore market volatility. They embrace it as an opportunity to practice emotional discipline. They don't pretend behavioral biases don't exist. They study them, acknowledge them, and build systems specifically designed to neutralize their impact. They understand that wealth management isn't primarily about managing money, it's about managing yourself. This realization changes everything. You've been sold a lie about wealth, not by any single person or institution, but by an entire culture that mistakes motion for progress and noise for knowledge. Every morning, millions of people wake up and immediately reach for their phones. They scroll through stories of overnight millionaires, day traders turned into legends, and young entrepreneurs who cracked the code to instant riches. The message is always the same: if you're not getting rich quickly, you're doing something wrong. But here's the uncomfortable truth that no one wants to discuss. The people making the most noise about their gains are often the ones losing the most money in silence. The modern obsession with rapid wealth creation has turned investing into entertainment. Apps designed like casino games complete with confetti animations when you make a trade. Social media influencers selling courses on how to 10x your money in 30 days. News channels that treat every market movement like breaking news worthy of your immediate attention. This isn't value investing. It's financial theater. Real wealth doesn't announce itself with fireworks and celebrations. It grows quietly, patiently, often invisibly to those around you. While everyone else chases the next hot trend, genuine wealth builders focus on something far less exciting but infinitely more powerful: time and compound growth. The Stoic philosophy understood this principle 20 centuries before Warren Buffett made it famous. Patience isn't just a virtue in building wealth, it's the only reliable path to it. Consider what happens when you chase quick profits. Your attention becomes scattered across dozens of potential opportunities. You start treating your portfolio like a video game where points are scored daily rather than a garden that needs years to mature. Every market dip feels like a personal failure. Every rally that you missed haunts you for weeks. This mindset turns you into your own worst enemy. You buy high because momentum excites you. You sell low because fear overwhelms you. You jump from strategy to strategy, never giving any single approach enough time to actually work. The wealthy think differently. They understand that getting rich quickly and staying rich are fundamentally different skills. One requires luck and timing. The other requires discipline and patience. Quick question: are you building wealth or just gambling with extra steps? Here's where most people get confused about what wealth actually means. They see it as an end destination, a number in their bank account that, once reached, will solve all their problems and make them permanently happy. This is the mirage that keeps people trapped in cycles of financial frustration. True wealth isn't a destination. It's a process of becoming someone who makes sound financial decisions consistently over time. It's developing the inner strength to ignore market noise when everyone around you is panicking or celebrating. It's building the confidence to stick with proven principles even when they seem boring compared to whatever investment strategy is trending this week. The Stoic investor approaches wealth building like physical fitness. You don't go to the gym once and expect to be strong forever. You don't eat one healthy meal and declare yourself permanently healthy. Wealth management works the same way. It's a daily practice of making slightly better decisions than you made yesterday. But our culture has a problem with anything that takes time. We've been conditioned to expect instant gratification in every area of life. Food delivered in 30 minutes. Entertainment available on demand. Information accessible with a single search. Why should building wealth be any different? Because money doesn't follow the same rules as everything else. Money responds to patience, consistency, and emotional discipline, qualities that can't be automated, outsourced, or hacked. The people selling you get-rich-quick schemes know this. They're not really selling investment strategies. They're selling relief from the discomfort of being patient. They're promising you a shortcut around the fundamental reality that meaningful wealth takes time to build. Every dollar you spend chasing shortcuts is a dollar you could have invested in assets that compound over decades. Every hour you spend looking for the next big opportunity is an hour you could have spent learning about businesses, understanding market cycles, or developing the emotional discipline that separates successful investors from everyone else. The Stoic approach to wealth rejects this entire framework. It asks a different question entirely. Instead of how can I get rich faster, it asks how can I become the type of person who builds lasting wealth. This shift in perspective changes everything about how you approach financial decisions. Have you ever made an investment decision based on what someone else was doing? If you're nodding along, you're going to love what comes next. Here's what I promised you earlier. By the end of this complete journey, you'll have a bulletproof system for making investment decisions that protect your wealth and your peace of mind. We're halfway there, and this next section reveals the secret that separates true wealth builders from everyone else. The stock market doesn't care about your timeline. It operates on its own schedule, following cycles that can take years or even decades to complete. Understanding this simple fact separates patient wealth builders from frustrated speculators. Long-term investing isn't exciting. There are no daily victories to celebrate, no dramatic comebacks to post on social media, no adrenaline rushes from perfectly timed trades. It's about as thrilling as watching grass grow. And that's exactly why it works. When you commit to holding quality investments for years rather than months, something profound happens to your relationship with market volatility. Those daily price swings that used to keep you awake at night become background noise. Market crashes transform from existential threats into buying opportunities. Bull markets become periods to stay disciplined rather than times to get greedy. This isn't just investment theory. It's practical psychology. The human brain wasn't designed to think in decades. Our ancestors lived in a world where long-term planning meant storing enough food to survive winter. The part of your mind that screams, "Do something," when your portfolio drops isn't trying to sabotage your financial future, it's trying to keep you alive using the only framework it understands. But markets operate on geological timescales compared to human attention spans. Companies that seem unstoppable today will be footnotes in business history textbooks 50 years from now. Industries that don't exist today will dominate the economy by the time you retire. Economic cycles that feel permanent are just chapters in much larger stories. The Stoic investor learns to think like the market itself, in decades rather than days. Here's what most people miss. Your ability to stay calm during market chaos isn't just good for your mental health. It's a competitive advantage that compounds over time. Consider what happens during a typical market crisis. Panic spreads through the financial media. Headlines scream about impending doom. Your neighbors start talking about pulling money out of the stock market and hiding it under mattresses. Everyone seems to agree that this time is different, that the fundamental rules of investing have somehow changed. This is exactly when long-term investing proves its worth. While everyone else is making emotional decisions based on fear, you have the luxury of perspective. You've seen this movie before. You know how it ends. Markets crash, recover, and eventually reach new highs. They always have. They always will. But staying invested during these periods requires more than intellectual understanding. It requires emotional endurance, the ability to sit still when every instinct tells you to move. The ancient Stoics called this amor fati, love of fate. Not passive acceptance of whatever happens, but active embrace of uncertainty as the natural order of things. Applied to investing, this means treating market volatility not as something to be avoided, but as the price you pay for long-term returns. Short-term thinking creates short-term problems. When you need your investments to perform within specific time frames, every market downturn becomes a potential disaster. When you're saving for retirement that's still 30 years away, temporary declines become irrelevant background noise. This perspective shift is liberating in ways that go far beyond finance. You stop checking your portfolio obsessively because daily fluctuations don't matter to your long-term goals. You stop losing sleep over economic news because you understand that economies cycle through expansions and contractions as naturally as seasons change. You stop feeling like you need to have an opinion about every market development because most of them won't matter next year, let alone next decade. The mathematics of long-term investing work in your favor in ways that few people fully appreciate. Given enough time, compound returns smooth out the impact of market volatility. Temporary setbacks become minor blips in otherwise upward-trending growth curves. Dividends reinvested during down markets buy more shares, which accelerate growth when markets recover. But perhaps most importantly, long-term investing aligns your financial strategy with your actual life timeline. Unless you're planning to retire next year, your investment performance over the next 12 months is largely irrelevant to your financial well-being. What matters is how your wealth grows over the next 3, 5, or 10 years. The people who struggle most with market volatility are those who haven't aligned their expectations with their actual needs. They treat long-term investments like short-term trades, expecting smooth, predictable returns from assets that are inherently unpredictable in the short run but remarkably consistent over longer periods. The Stoic investor embraces this paradox. They accept short-term unpredictability as the price paid for long-term wealth creation. They understand that the same market volatility that terrifies impatient investors is what creates the opportunities for patient capital to compound into meaningful wealth. This isn't about blind optimism or naive faith in markets always going up. It's about understanding that your emotional comfort in any given moment is far less important than your financial security over decades. Think about this. What would change in your life if you could completely ignore daily market movements? That freedom is closer than you think. When you truly internalize this principle, something remarkable happens. You start seeing market downturns as sales rather than disasters. You begin looking forward to corrections because you know they create better entry points for additional investments. You develop the rare ability to stay calm when everyone around you is losing their minds. This emotional steadiness becomes your greatest asset, not just financially, but psychologically. Stillness is not emptiness. It's clarity. In a world that profits from your confusion, your ability to think clearly becomes your most valuable skill. Every day, thousands of experts, analysts, and commentators generate millions of words about what's happening in financial markets and what you should do about it. Most of this information is not designed to help you make better decisions. It's designed to capture your attention and generate revenue for the people producing it. The Stoic investor learns to distinguish between information and noise. Information helps you make better decisions. Noise just makes you feel like you need to make decisions. Real investment strategy isn't about reacting to daily market movements or trying to predict what will happen next week. It's about building a systematic approach to growing wealth that works regardless of what markets do in the short term. This requires stillness, not the absence of action, but the presence of intentional, thoughtful decision-making. Consider how most people approach investing. They read an article about a hot stock and immediately want to buy it. They hear about a market crash and instantly want to sell everything. They see their neighbor making money with cryptocurrency and suddenly feel like they're missing out. Every piece of information feels urgent. Every market movement feels like it requires an immediate response. This reactive approach guarantees poor results. You end up buying high during periods of market optimism and selling low during periods of market fear. You chase trends instead of following principles. Your investment strategy becomes a series of emotional reactions rather than a coherent long-term plan. The alternative approach requires developing what ancient philosophers called ataraxia, unshakable tranquility in the face of external chaos. What would your investment returns look like if you made decisions based on logic rather than emotion? Building an investment philosophy grounded in stillness starts with understanding what you can and cannot control. You cannot control market performance, interest rates, inflation, or economic cycles. You can control how much you invest, where you invest it, how long you stay invested, and how you respond to market volatility. This distinction is crucial because most investment anxiety comes from focusing on things outside your control while neglecting things within your control. Risk management, often misunderstood as trying to avoid all possible losses, is actually about accepting that losses are inevitable while ensuring they never become catastrophic. The Stoic investor doesn't try to eliminate risk, they manage it systematically. Proper asset allocation isn't about finding the perfect mix of investments. It's about building a portfolio that can survive whatever markets throw at it while still generating the returns you need to reach your financial goals. It's about being prepared for multiple scenarios rather than betting everything on one specific outcome. Decision frameworks become essential when emotions run high. Before you ever find yourself in a market crisis, you need predetermined rules about how you'll respond. When will you rebalance your portfolio? Under what circumstances will you sell an investment? How will you decide when to invest additional money? These frameworks prevent you from making fear-based or greed-based decisions in the heat of the moment. They give you a systematic way to respond to market conditions without having to rely on your emotional state at the time decisions need to be made. The beauty of this approach is that it removes the psychological burden of trying to time markets perfectly. Instead of constantly second-guessing yourself, you follow predetermined principles that you've thought through carefully during calm periods. Stillness also means being comfortable with not knowing what markets will do next. This isn't a weakness, it's wisdom. The people who claim to know where markets are headed next are either lying to you or lying to themselves. Markets are complex systems influenced by millions of variables that no single person can predict or control. But you don't need to predict market movements to build wealth. You just need to position yourself to benefit from the long-term growth of productive assets while protecting yourself from the inevitable short-term volatility along the way. This perspective frees you from the exhausting task of trying to outsmart markets and allows you to focus on what actually matters, consistently investing in quality assets over long periods of time. Here's a challenge for you. Can you name 3 companies you believe will still be profitable 20 years from now? Your answer reveals whether you think like a trader or an investor. The strategy of stillness isn't passive. It's actively choosing not to react to noise while remaining fully engaged with the fundamentals that drive long-term investment success. It's developing the discipline to stick with proven principles even when they seem boring compared to whatever is generating headlines this week. When you master this approach, you discover something remarkable. The same market conditions that stress out reactive investors become opportunities for disciplined investors. Market volatility stops being something that happens to you and starts being something you can use to your advantage. This is the competitive edge that stillness provides, not the ability to predict what will happen next, but the emotional stability to respond appropriately to whatever does happen. Money is not the goal. Freedom is. This realization hits you like lightning once you truly understand what wealth management can accomplish. All the spreadsheets, all the market analysis, all the careful planning and patient investing, none of it is really about accumulating numbers in bank accounts. It's about purchasing something far more valuable, the ability to live life on your own terms. Financial freedom doesn't mean having enough money to buy anything you want. It means having enough money that you never have to make decisions based purely on money. It's the difference between working because you choose to and working because you have to. Between staying in relationships that fulfill you and staying in situations that merely pay the bills. The Stoic investor understands that wealth is not an end in itself, but a tool for achieving something deeper, autonomy over your own life. Remember that promise I made at the beginning? That you'd understand exactly how to build unshakable mental resilience in any market condition? Here's where everything comes together. When money becomes your servant rather than your master, your entire relationship with financial markets transforms. You stop checking your portfolio obsessively because your day-to-day happiness doesn't depend on daily market movements. You sleep better during market crashes because your financial security doesn't hinge on short-term volatility. You make clearer decisions because desperation and greed no longer cloud your judgment. This is the ultimate dividend of following Stoic principles in your financial life. Psychological liberation from the very thing you're trying to build. Consider how most people relate to money. They work jobs they hate to afford lifestyles they don't need to impress people they don't like. They sacrifice their present happiness for some imagined future when they'll finally have enough. They treat their net worth like a scorecard, measuring their self-worth by their financial worth. The Stoic approach rejects this entire framework. Wealth becomes a byproduct of living according to sound principles rather than the primary goal driving all decisions. Financial freedom becomes not just having money, but being free from the psychological baggage that money creates for most people. This doesn't mean being careless with money or pretending it doesn't matter. It means understanding money's proper place in a well-lived life. Important enough to manage wisely, not important enough to sacrifice everything else for. When you reach this level of understanding, something remarkable happens to your investment behavior. You become naturally better at making rational decisions because emotional desperation no longer distorts your thinking. You develop genuine patience because you're not depending on investment returns to rescue you from a life you hate. You gain the confidence to ignore market noise because your sense of security comes from within rather than from external validation. The ancient Stoics had a term for this state, autarky, complete self-sufficiency, not in terms of isolation, but in terms of inner stability that doesn't depend on external circumstances. Applied to wealth management, autarky means your peace of mind doesn't fluctuate with your portfolio balance. Your self-respect doesn't rise and fall with your investment returns. Your life satisfaction doesn't depend on reaching some arbitrary financial milestone that keeps moving further away every time you get close to it. But here's the paradox. The less desperately you need investment returns to make you happy, the better your investment returns tend to be. Emotional desperation leads to poor decision-making. Inner peace creates the psychological space for rational thought and patient action. The Stoic investor achieves something that most people spend their entire lives seeking but never find: contentment that isn't dependent on external circumstances. Not the contentment of having everything you want, but the contentment of wanting what you have while working steadily toward goals that truly matter to you. This doesn't happen overnight. It's a gradual process of aligning your financial behavior with deeper principles about what makes life meaningful. It requires regularly examining your motivations, questioning your assumptions about what you need to be happy, and choosing long-term flourishing over short-term gratification. The ultimate test of whether you've mastered Stoic investing isn't whether you make money. It's whether you can lose money without losing your peace of mind. Whether you can watch your portfolio drop 30% during a market crash and still sleep peacefully because you know that temporary setbacks don't change your long-term trajectory. When you reach this level of emotional mastery, you discover something profound. The market becomes your teacher rather than your opponent. Every period of volatility becomes an opportunity to practice patience. Every temptation to chase trends becomes a chance to strengthen your discipline. Every moment of uncertainty becomes training for the kind of mental resilience that serves you not just in investing, but in every area of life. The Stoic investor doesn't escape market volatility, they transcend the psychological impact of market volatility. They remain fully engaged with the practical work of building wealth while maintaining the emotional equilibrium that makes that work sustainable over decades. This is true financial freedom, not having so much money that markets can't affect you, but developing the inner strength that allows you to thrive regardless of what markets do. Not eliminating uncertainty from your financial life, but becoming comfortable with uncertainty as the price of meaningful growth. In the end, the greatest return on your investment in Stoic principles isn't measured in dollars. It's measured in peace of mind, clarity of purpose, and the rare satisfaction that comes from knowing you can handle whatever life throws at you. The market will always be volatile. Economic cycles will continue. Financial crises will happen. But you, armed with ancient wisdom applied to modern challenges, will remain unshakable. What's your biggest takeaway from this journey into Stoic investing? Drop a comment below and let me know which principle resonated most strongly with you. Your insights might just help fellow investors on their own path to financial freedom.